Hello, everyone. Sorry, I'm a few minutes late. Running over today on meetings. So, today we are going to go over DSCR LLC only versus just a traditional LLC. And then there's actually one that's like a hybrid DSCR loan in there. And we're going to go through all of that today. So give me a second to upload the file. While we're here, as always, comment where you are listening from. If it is warm there, it's starting to warm up here in Tennessee. It's a little chilly still, but still getting there. It's spring, that's for sure. All right, so we're adding this to the stage. Here we go. Okay. So, DSCR LLC only versus traditional DSCR. There is a difference. So if you've ever emailed me or messaged me and you're like, hey, I think I need a DSCR loan, I ask you, okay, do you want this in an LLC only? Are you okay with your name on the mortgage note with the LLC on title? Do you just want it in your personal name? You know, what is your scenario? There are different types of DSCR loans. Many lenders do not know the difference, and they may put you in the wrong one. So this is a presentation just to essentially help you know which one you exactly need, and the questions to ask to make sure that you get the one that you need. So for a DSCR LLC only, you're going to have a business loan affidavit with the documents that your lender has. So that's because it's essentially a business loan. You would create an LLC, or if you already have an LLC established, you can do that. You can create an LLC, though, for this property. I get a lot of questions of, well, I don't want to create the LLC yet before I get under contract because I don't know which state I'm going to be in, or things like that. What if the property falls through? That's totally fine. You can create the LLC after you get under contract. What we do with an LLC only loan is we say, hey, they're closing in their LLC. We don't quite have the EIN number for that LLC yet, but we will. So just know that this is LLC only. It should not report to your credit. So a true LLC only will not report to your credit at all. Why? Because it's not in your personal name. It's in an LLC. LLC is the only thing on the mortgage note, not your personal name. It's going to say, let's say your name is Bob Smith. It's going to say Bob Smith, member of 123 LLC, and that's what you are going to sign as. That's just saying that you are the member signing for the LLC, because an LLC is not a real person. Somebody actually has to sign for the LLC. If you were just joining, don't worry. This is recorded, and I will post the recording after this for you. I know this is a popular topic, so we will save it for you so you can go back and make sure you're in the right product that you need. And then the LLC is on title only. So LLC is only on the mortgage note only. LLC is on title only. That is a true DSCR LLC only loan. I will open it up for questions at the end. So if you do have questions, you can save them for the end so I can go over them with everyone. If you feel like you're going to forget your question, you can put it in the chat and I will get to your question as well. Okay. There is a hybrid LLC. So there's an LLC only, but there's also what's known as a hybrid LLC. This is where the LLC is on the mortgage note, like before, but the LLC owner's name is as well. So, like I said, on the LLC only, you will see Bob Smith, member of 123 LLC. For this hybrid LLC one, you will see Bob Smith, member of 123 LLC, and then you will see another borrower, Bob Smith. And you sign twice as Bob Smith. It usually does not report to your credit, but can depending on the lending company. We do have a hybrid LLC loan like this that does not report to your credit. This is where it's going to get a little sticky for you. So just know that this is still beneficial to keep off of your debt to income ratio, but it can count against your debt in certain situations. So it will not count against your debt unless it does obviously report to your personal credit. You file the property on Schedule E. So we talk about this a lot. You file your property on Schedule E, which is where you file your normal rental properties in your personal name. And we get that mortgage statement showing your name on it as well. In this case, it doesn't necessarily count fully against your debt to income ratio. It just counts in the income calculation for your rental income on that property. So for example, you've seen me calculate Schedule E rental income at the end. Whatever that number is, we just subtract your monthly mortgage payment from that to come up with your net income. So it's not really counting against your debt, but it is counting against that income for that property if you report this on your Schedule E and we see that your name is on that mortgage statement as well. However, let's say you close this in an LLC. You file a separate business tax return. So if this is your first time, let's say you did an LLC, you can either do what's known as a pass-through entity LLC on your personal tax return, which is usually in the form of a Schedule E, or if it's an actual self-employed business, it'll be Schedule C as in Charlie. But let's say you have a partner in this. Let's say I have many clients come to me with doing an LLC and it's two members of that LLC, right? They're going to file normally a 1065 partnership tax return. That is a separate tax return from your personal tax return in the same year. It's just a tax return with your partner to show your percentage of ownership in that property in that LLC. If you file it on that, it's filed on a form called an 8825, the same thing as a Schedule E, except for a business return, okay? If you file on that, it will not account against your debt to income ratio, and it will not count into the gross rental income or debt if not reporting to credit. We will still be able to add back in your depreciation from that tax return for this property. So keep that in mind. If you do the hybrid LLC, that's the way I would suggest if you wanted to truly keep it off of your personal finances, especially if you have other personal properties on your Schedule E. Well, Brenna, why would I do this one and not just do the LLC only? Many times this one will have better rates for you. It'll have better interest rate options for you and lower prepayment penalty options for you at a lesser interest rate. That is why some will do this one over a true LLC only. As a true LLC only, again, will only show that LLC name on the mortgage statement, and they can be a little bit higher sometimes in interest rate. Not by much, but a little bit. Now, traditional DSCR is literally if you just come to me and say, I just want a DSCR loan, it's going to be my personal name. Done. Okay. It requires you to personally be on the mortgage note. You will be the only one on the mortgage note, whoever's on that loan application. You will sign as the LLC on title if you wanted to title in the LLC. But your name would be the only one on the mortgage note. So you can close this in your personal name and title in an LLC, but you personally would still be liable for that debt. It may or may not report to credit bureaus. This is where many of you will get messed up in your finances. Just because something doesn't report to your credit doesn't mean it's not a debt that will be counted against you. For example, let's say you did a seller financing deal and you are paying that mortgage. It doesn't show up in your credit. Some community banks will do a bank loan for you, like a conventional loan, but it's like their product. And they just don't report to credit because they don't have the money or servicing to do so. It wouldn't report to your credit, but guess what? If your name's attached to that property, it would still count against your personal debt to income ratio. So if it does report, if it does not report, it still counts against your normal debt to income ratio. Well, Brenna, how do you know? We have systems in place where we can see every type of real estate that your personal name is attached to, whether mortgage note or title. It's kind of scary. It's the same systems as, the FBI and everything have, but that's what lending institutions have at their willpower. So we would most rather you obviously tell us up front, because sometimes we won't pull that report until you're in underwriting and then see, oh, you have another property that's in your personal name. This could mess up your debt to income ratio. So always be upfront with us on if your personal name is on a mortgage or any type of title and things like that. So these are the three DSCR types. So again, LLC only, you're good to go, no debt to income ratio issue. A hybrid DSCR loan, which still doesn't count against your debt to income ratio unless you're now needing to use that property's rental income to qualify, and it's listed on your Schedule E as an echo. And then you have the traditional DSCR where you close the mortgage note in your personal name and either title in your personal name or title in the LLC. Many of you ask if you can title conventional, if you can close a conventional loan in an LLC. You cannot. The conventional loan is personal all across the board. So that's the difference between a traditional DSCR and a conventional. You can title in an LLC. All right. So questions to ask these lenders. Will this report to credit? Get written email confirmation. Like, what type of one is this? Is this an LLC only? Is this a hybrid? Is this, basically that's all you have to ask if you're wanting one in an LLC. If not, will my personal name show on the mortgage statement as well? This is a big one, guys. There is a big lender out there that said they will not report to credit. They do a hybrid LLC. It's not an LLC only. They have been reporting to credit. Many of you watching probably have had this done to you because I've had you come to me. I'll explain in a little bit how you can get that taken off of your credit report if it's a hybrid. How many of these do you do in a month? So this is the question you ask the lender. How many of these do you do in a month? And has your company had issues with reporting to credit when they shouldn't? If so, what's their process of getting it removed from that credit? You want to ask that because that's very important, because a lot of times after they close your loan and they're done and then it reports to credit, you have to get in touch with their servicing department to get it taken off of your credit. Sorry if you hear my dogs barking in the background. If that happens where it's reporting to your credit, you need to show them the original mortgage note saying it was my LLC's name. I did not personally, guarantee this. And due to, remember this, the Fair and Accurate Credit Reporting Act, not Fair Credit Reporting Act, Fair and Accurate Credit Reporting Act. The acronym is FACRA. Please take this off of my credit report because this is not my personal debt. I have the email where you said this was an LLC only. Please remove this from my credit report and send me confirmation once you do. So that's how that works. Now I'm going to open it up for questions. If you all have any types of questions, again, This could make or break your deals for the next 2 to 3 years. So you want to make sure you get in the right product, because let's say I tell you, again, you need to buy a primary residence in the next year or the next year and a half. And then we do a regular DSCR because your debt to income ratio doesn't really qualify. It reports to your credit because it's your personal one. You're still going to wind up in the same situation where you can't qualify next year. So I say, let's do an LLC only DSCR. That way you're set up for success next year, whether you're trying to get a conventional investment again or a second home or a primary residence. Very crucial in which one you pick. So here's my contact information if you want to reach out for any questions. Brent@mortgageshop.co, not .com. My Instagram handle. This is a part of Financing Short-Term Rentals. So our Facebook page, Financing Short-Term Rentals. You can go in there and ask any and all financing questions that you have. And then obviously our YouTube channel, where you can find these live replays there and watch them and take notes and repeat and everything like that as many times as you want. And then our number to the mortgage shop, the mortgage company that I own. So I'm going to stop presenting there and open it up for questions. Can a foreign national obtain a traditional DSCR when the property title is on a personal name? I think you mean, like, can you just get a DSCR loan and have it in your personal name? Yes, there's foreign national DSCR loans out there. I do believe they allow you to do personal name or, an LLC if needed. Generally, though, just remember that it is 25 to 30% down for foreign nationals. Some DSCR lenders will require you to own property already in the States. Some do not. So it's good to work with somebody like us that know what we're doing essentially in that loan type. So yes, you can do that. And while I am waiting on other questions, I'm going to put my contact info up there again. If you want to schedule a call with my team and I, you can go to mortgageshopmlo.com. That just stands for Mortgage Loan Originator. Or call us at 800-816-7982. And Instagram, Financing Short-Term Rentals. Let me hide that. Any other questions? I will give it a few minutes. Today's live on questions. You are welcome, Erin. What is the traditional DSCR rate, and is there a credit score requirement for a foreign national? Usually credit score needs to be at 680 or higher. If you are at top tier credit, which is 760 or higher with DSCR, and have at least a 1-to-1 ratio, you're going to be starting out probably around a 7.125 to 7.25 interest rate. Again, that's 1-to-1 ratio, 20% down, top tier credit 760 or higher. And this is property specific, right? So if y'all come to me and want me to quote a rate, I can be like, if it is this, because it's property specific, right? That would also be with prepayment penalties. So DSCR loans can come with prepayment penalties. The lower interest rate you can get will probably have a higher prepayment penalty. There are some with 2-year. A lot of my investors are doing that 2-year. It's a sweet spot. It's still 30-year fixed. And you're seeing that 7.125 range, which is not far off from a conventional investment. So it's a really good product to be in. Is it normal for a DSCR loan to have your personal name listed as co-borrower? LLC as borrower. So, excuse me. Deborah, this is what I was talking about. So you did a hybrid LLC, a DSCR, which means you signed your LLC on the note and on behalf of your LLC, and then you signed as another borrower. So if you have that, I'm going to pull up this slide again and show you. So this is the hybrid. It will count against your debt to income ratio if you, essentially, if you need to use it for rental income purposes. If not, and doesn't report to your credit, since it has the LLC on that note and title, usually it won't count against your debt to income ratio. Can I take out an LLC only DSCR on one of our properties that isn't short-term rental, but I own it? Yes. So if you own it in your personal name now and you want to refinance into your LLC, that is perfectly fine. And we're able to do that to take that off of your debt. Remember, some states will require transfer taxes again because they see that your entity is another person as opposed to you. Some states see it's an extension of you. So your fees could be a little bit higher in title fees as opposed to a discounted rate with a refinance. So just keep that in mind. But yes, we can do that. Personal name to your LLC is completely allowable with DSCR. You just have to be, you know, the owner, or at least 50% owner of that LLC. What about a credit rate for national no credit score in the U.S.? So usually DSCR loans won't work for you then if you have a no credit score. You at least have to have an established credit score. If you want to reach out to Lloyd on my team, Lloyd at mortgageshop.co, he specializes in the foreign nationals, and you can reach out to him. Brian, DSCR LLC only, typically or always 20% down or more? Usually 20% down. Usually you don't have to do more unless you're going over a 1.999 loan amount, $1 million loan amount. Anything over that is usually 25% down. There's some that can do an exception, but your rate's going to be a lot higher. There are products out there that we can do 15% down DSCR, but again, if your whole reason for cash flow is that, your rate's going to be higher in like the 8%, 8.125% range for just 15% down, and it's hard to cash flow with that, so just keep that in mind. Assuming you have the down payment, how many months of rental income do you need to have before that income qualifies for a DSCR loan? Down payment. Oh, great question. So if you're purchasing a property, it doesn't have to have previous rental income history. It can be a new build. It could be poorly managed before. It doesn't matter. We don't have to look at the actual income the property made. We look at comps around it, usually with things like AirDNA or STR Insights. We look at that for you. So same bed, bath count near the vicinity of your property, likely comps, and use that average for your income. Now, if your property is performed really well before and they're selling it and you want to purchase it, we can use rental income actuals on it as opposed to AirDNA. That's preferred. A lot of times I'll go on AirDNA or something like that and see that the proposed rental income for a 4-bed, 4-bath is $67,000 a year. I'm like, that's not accurate because there's just not enough information in that area. But if your property that you're purchasing has already got actuals of like 120,000, then we're able to use that instead. So I usually always ask, when you bring a property to me, I say, does it have rental income actuals? Like, what were the last 12 months gross? If not, that's completely fine. I just want to have both options out there for you just in case. Erin, what if I own it outright? So her first question was, can I put it in an LLC? If you don't want to, if you're wanting to do a cash out refinance, we can do the LLC option. If you don't want to have any cash out and you want it to be put in the LLC, you will do what's known as a quit claim deed with the title company of your choice. Probably I would go with the one that you closed property with or you have a relationship with, because they can hopefully give you a little bit of a discount on it. And you would just quit claim title to your LLC. Or you can do the cash out refinance if you need equity out of it, and then close in that LLC of yours. Dee Dee, where can we rewatch? You can rewatch on Facebook. It'll just be replay. It'll just be a link on my Facebook page where you can watch it, or you will go on our YouTube channel, Financing Short-Term Rentals, and it will be available for replay on there for you. I will post the replay links in the comments. What are current terms for cash out DSCR? So normally a cash out DSCR loan is up to 75% loan to value. There are some floating around out there that are like 80%, but they're high in interest rate. But normally your run-of-the-mill, easy to close is 75% loan to value. Credit score, again, top tier 760, 1-to-1 ratio. You're probably going to be around that 7.125, 7.25 interest rate range starting out. What credit score do I need for LLC only DSCR? At least a 680 credit score. That would usually do 20. Some of them will allow 20% down with 680. Some require 25% down. As soon as you hit that 700 credit score, you are able to put just 20% down. If the property title is on a limited partnership, but would I be able to obtain a DSCR loan? So I'm assuming you're talking about limited liability company. That's a 1065 partnership return. Yeah, if you want to if you own part of that LLC and you own at least 50%, or owners collectively, let's say there's 4 of you and y'all own 25% each, these 2 of you can go and apply for that DSCR loan for that LLC and refinance it into the LLC. If you're talking about purchasing a property, it doesn't matter who that title is in right now. You would just purchase and get qualified for a DSCR loan, no matter how the current owners have it titled. You are welcome. Hopefully this kind of clears things up. I know it can get a little swirly with LLCs and how you can close and how to transfer title to an LLC. But it's pretty simple across the board when you get down to it. Do you have any single DSCR loan product that cover, a portfolio of properties? Some lenders call it a portfolio loan. Is there a benefit of doing it this way? All DSCR loans are generally referenced as portfolio or non-QM loans. What you're probably talking about is a blanket loan, which is a portfolio non-QM loan. Yes, we do have a product like that. You have to send your personal situation, because some will allow if they are, deeded together, or they have to be on separate parcels. If they are in different states, we have to find a title company or title attorney that is licensed in both of those states to be able to close that actual deal for you under a blanket loan. So is there a benefit of doing it this way? Unless unless it's the biggest time I see a blanket loan is if there's 4 properties together, 4 houses together on the same acreage where it's deeded together. Some might be parceled separately but sold by the same owner. Yes, you can do that, and that would be beneficial with a blanket loan. If the other one would be if you're trying to maybe refinance 4 of your properties all in one. I still don't know about that one, because we'd want to run the numbers on that, because you'd want to make sure that it's saving you money in the end, because the rate's going to be higher. You're essentially trying to save on refinance costs at that point for 4 loans instead of 1, but your rate will be higher, so your cash flow will be less on each of those properties. So you have to keep that in mind. And then that's usually the 2 reasons why somebody would get a blanket loan, as opposed to just purchasing one by one. That's going to be your best, most efficient way with lower interest rates. Well, thank you. I try. I try to get y'all as much education as I can, so y'all will know and be armed with the best knowledge possible. Will lenders accept a credit score from overseas for a foreign national? So credit score is like U.S. thing with, a social security number or ITIN. So that's the whole point of a foreign national loan. You don't live here, but you have established credit. So yes, I think that's essentially what you're asking. Any other questions? I love that y'all are learning and asking these are the right questions to ask to prepare yourself for the loan type. And then working with a lender that knows what they're doing. I heard risk with portfolio loans is if one property is part of a lawsuit, all are opened up to litigation. Haley, you're talking about one of those blanket loans? Yeah, I mean, if you close it and it's one LLC that owns all of them, or you're personally trying to do it. Most blanket loan lenders, by the way, want you to close an LLC. But yes, if it's under one LLC, then if somebody sues you and has enough money and time to go after you in court, which most won't, but let's say you find someone that does. If you have a lot of equity in the properties, they have something to go after. If you don't have a lot of equity in the properties, they don't. So there is that risk if there is a lot of equity in those properties as a blanket loan, as opposed to having separate loans and separate LLCs for those properties. I'm not an attorney, but essentially if it's under one LLC, they can look at all of that stuff and go after any equity that LLC has if they have the time and money to do that. If there is no equity and with the LLC, or there's nothing, and they can't pierce the veil of that LLC to get to you because you have the right insurance in place, you've paid your bills on time, it would be very hard for them to go after anything else that you own if you own things in their separate little entities and such. Why do I know that? Because I have a good friend that's a real estate attorney. And we've talked in depth about that kind of stuff. How do you find out a credit score with someone with an ITIN? We run it the same way as we do a normal credit report. We just get your ITIN and your application. Any other questions? LLC Only DSCR. I would say do that one if you are maxed out on debt to income ratio and you need to kind of pivot for a second until you can show rental income on your properties. And then you can pivot back to conventional, because guess what? That LLC Only DSCR won't show on your debt to income ratio. Hybrid you can do if, let's say you're planning on filing on a separate tax return, like a partnership, and you just want to utilize that lower interest rate. Or when people say LLC, a lot of you guys are just wanting to protect your personal name, right? So you can do the hybrid one because you're closing in an LLC. Even from what my real estate attorney friend says, California is a little bit different. I don't really know how they work. You'd have to talk to a real estate attorney. But even if you didn't have an anonymous LLC like a Wyoming LLC, and you close in an LLC, let's say you close a property here in Tennessee, and you close in an LLC here in Tennessee, that's yours, and people can look it up that you're the owner. If you maintain correct insurance on that property and you pay your bills, you don't have intermingled funds, your business funds shows clearly from that checking account, there's really nothing that they can go after you personally for, because your LLC has played by the rules for that property and has kept up with their debts and insurances and everything like that. So just keep that in mind. Personal DSCR, I would say, why would you do just a personal? Probably If you don't have many properties and maybe it's your first one, but you can't qualify conventionally, your debt to income ratio is for some reason too high, I would say let's look into it, because we would want to try to use that rental income anyway the next year once you report it to help you start qualifying for another property. Another reason would be, again, if you're a first time investor, for conventional Fannie Mae and Freddie Mac guidelines, they say if you don't have any prior rental experience, the proposed rental income that you can use can only offset the mortgage payment that you're trying to get. If you do have previous landlord experience, which means you've owned a short-term rental or long-term rental for at least 12 months and can show that, you can use the full amount that comes back. So for example, let's say your proposed mortgage payment is going to be $3,000, but that rental income comes back at $6,000, and you can show that you've owned an investment property for at least 12 months, you can use that full $6,000, which can really help you offset your debt to income ratio for that specific deal. So that's why I look at all of your scenarios together and see which of the three options would be best for you. Hopefully that makes sense. Okay, I will give it a couple more minutes if any of you have any last questions. And if not, this will be available for replay, so I'll post it, the replay. Facebook will show it. And then it will be on YouTube for you to watch live. Or not live, but the replay. Can DSCR loan lender fees be wrapped up into new loan amount? If it's a refinance, yes. If you've got enough equity in the property, we can up your loan amount to cover your closing costs. So yes. If it's a purchase, no. Now you can get seller credits towards your closing costs to cover your closing costs on a purchase, which is essentially kind of like financing your closing costs. And this is how it works. Let's say somebody wants $500,000 for a property, a seller. You need $10,000 in closing costs. You go to your agent and say, do you think this property would appraise for $510,000? And they say yes. Say, okay, I'm going to offer over asking for $510,000, and I want sellers to pay $10,000 in closing costs. 510 minus 500 is, I'm sorry, 510 minus 10 is 500. So the seller's still getting what they need at closing. You're essentially now wrapping those closing costs into your loan. It appraised, and you're only out of pocket with your down payment. Hopefully that makes sense. So there's no money transferred at closing between you and the seller. They are netting the same thing from that purchase. You're essentially now just offering more for that property, one, because you're a realtor and you are confident it will appraise for as much, and two, essentially financing them in so you don't have to pay that at closing. Any other way though, no, you can't really say, hey, my closing costs are this, can I just add it to my loan amount? You kind of have to be strategic with it to use seller credits for a purchase in that event. Awesome, guys. Well, this has been an awesome session. You've asked really good questions. For you all watching the replay, I really recommend going through the questions that we have answered, because a lot of them will be the same questions you have. And then again, if you have any other questions come up, feel free to reach out to me and email me your questions, and I will be happy to chat with you. All right, guys. Thank you so much. See ya.